Hey guys, how's it going? I'm Lewis Harding Investor and welcome back to my YouTube channel, and in today's video I'm going to go through how to value stocks using a DCF valuation model. If you're new around here, please subscribe to the channel and leave a like and a comment on the video. Without further ado, let's get into it. This is not a recommendation. This video should be seen as a source of information and education only. Please seek a regulated financial advisor if you are unsure of any investment. So yeah, how do you value stocks? Well, I use the Warren Buffett way of valuing a stock, and that is the value of a stock, or let's say the value of a company, is the present value of its future cash flows. So very simply, this is the way Warren Buffett and many other great investors value businesses and companies. They take all the cash flows going into the future, they discount them at an appropriate rate, and then you divide that by how many shares, and that's the value of your shares. Pretty simple, really. Many investors have spoken about this many times in interviews, including Warren Buffett in his Berkshire Hathaway meetings. Bill Ackman has spoken about this, and this is, to be fair, among investors, this is the most known way to value companies. So yeah, I like to keep this as simple as possible. Like as with everything, things can get really complicated really quickly. So let's just run through a few key points which you need to understand before you get into the DCF model. So yeah, in Berkshire Hathaway's 1986 shareholder letter, Warren Buffett stated that the very simple way to value a business is take all the future cash flows that the business will produce over its life, and then discount them at an appropriate rate, and that's the way to value a company. So let's take it from the Oracle of Omaha himself. Very simple way. Things don't need to be much more complicated than that. So if we can find a simple way of valuing a company using its free cash flows, that's all we need to do, and then we can go from there and then looking at the stock. So yeah, let's get into free cash flow. So essentially what free cash flow is the amount of cash available on hand for the company to use to pay off creditors and debt, to pay dividends, and also share buybacks and acquisitions. So it's a very important figure in terms of investing. It's the cash available on hand for the company to do whatever it needs to do, and what you want is this company to be cash flow positive, so it's bringing a lot of cash in year on year, and that's why you'll often see me talk about I don't invest in profitable companies, and I don't really invest in companies which don't produce any cash flow, because when they run out of cash, it's bye-bye. So I like to keep it very simple. So in summary, free cash flow is the cash available on hand for the company to use for various different things, and this is really key, as you'll see going on to the next bit. So yeah, the next part of the free cash flow, well, the discounted free cash flow valuation, which I need to explain, is why do we discount the cash flows? Well, put it simply, the value of money over time decreases. Very simple, and that's why we discount the cash flows going into the future. We can use whatever rate we think is appropriate. I personally use 10% for my stocks, mainly because if an index fund can return 7%, I want my stocks to return at least 10% as a bit of a premium. So essentially I discount my cash flows at a rate of 10%. Some people might think this is quite high, but I think it's reasonable, going on historic averages of what the market has returned. If I'm investing in individual stocks, I want a bit of a premium, and I want 10% plus. So yeah, if you want to learn more about discounting and free cash flow, I've got some playlists on my channel where you can go on there and learn about free cash flow from other YouTube content creators, such as Learn to Invest and Everything Money. They do a really good job of going through this. I will be doing some individual short clip videos on this soon, but I wanted to get this video out there first, to be totally honest. So yeah, now we've gone through what free cash flow is and why we discount the free cash flows. Let's get on to the discounted free cash flow valuation, and I'll head over to my laptop and we'll go through it from there. So yeah, now I'm on my laptop, let's go through the discounted free cash flow valuation. But before I do, I have put together a really cool spreadsheet, how to analyse and value stocks, which is available on my website for download for free. I'll put the link in the description below. I mean, this spreadsheet has all sorts of resources. Yeah, so the resources page, we've got all the tools I use for analysing and valuing stocks. Various YouTube channels to have a look at, playlists, podcasts, and books. So yeah, all sorts of good stuff there. So you can get this download for free on my website. The link will be down below. As an analyst process and an analysis checklist, which we'll get into. But yeah, let's just get right to it. When looking at step one, so this spreadsheet is actually Learn to Invest Dreamy spreadsheet. He gives it out for people for free, so I thought I'd just use it as my own in terms of using value stocks. I use it to value my own stocks as well, so I think it's a very, very simple way and very quick and easy way to value stocks, which is absolutely key. Let's be honest, you want to get as much done as you can as quickly once you've done your analysis. So yeah, step one, this is the step one tab. So yeah, you put what year projections in, you put your company ticker symbol, personal required rate of return. We spoke about this before. My required rate of return is 10%. Other people use lower numbers, other people use higher numbers. It's down to personal preference. There's no right or wrong answer. You just need to make sure it's reasonable for what you're wanting. And then the next column is shares outstanding. So we'll find this from Google Finance or Market Screener. Probably Market Screener is probably a bit better. Alphabet's a bit funky as well because it's got 3 classes of shares. So let's have a look. So yeah, if you add up 300, 307, sorry, that's the wrong figures. 301, 46 and 324, we come to here and that comes to 675, the total shares outstanding. This is in millions, by the way. Perpetual growth rate, essentially this is what rate you think the economy is going to grow at. So all companies mature to a certain point and you assume that they are going to grow alongside the economy. So 2.5% is a decent figure to use for that. So let's go into the actual figures where I get these from. So this first step page is essentially like a summary page, so you can have a quick overview of some of the figures. You don't have to fill it all in, but I think it is a really good way of just overlooking the figures in a very simple format. So I get all of these figures from Yahoo Finance. So cash flow from operating activities, we can come onto here, onto the cash flow statement, and these figures should be around here. So what was it? Cash flow from operating activities. Perfect. 65124. Yeah, there we go. So these figures here come to here. Capex is right here. So these two figures come to here. And you can see they've already done the free cash flow for you already. So you can see Google's free cash flow in 2017 was very, very high, like nearly 24 billion. And 2020, we're now looking at 43 billion. So absolute Goliath of a company at Google. And then also, the income statement data. This all comes from Yahoo Finance as well. So we'll go to the income statement and here I'll just show you where the figures come from. Pretty self-explanatory. It's not rocket science. You just pick out the figures and pop them in your table, and it's just to review your net margins. And then going on to the balance sheet. This is to have a look at how much debt they've got. As you know, I don't like companies with debt. Google don't have much debt at all. And you also get these figures from the balance sheet on Yahoo Finance. Yeah, there we go. So let's find the long-term debt. Oh, I need to update that figure actually. Didn't realise that was wrong. Looks like I've just not updated a figure in there, but no biggie, is what it is. I'll leave it to now because it's not too important. Actually, no, I will, because it does affect it. Sorry. 25078. Let's just update that figure. 25078. Sorry, I mistyped there. So let's have a quick look. Now we've put these figures in, let's go to step 2, which is forecasting free cash flow. This is probably the most important bit, and it's a bit you need to be very, very conservative on. So I only ever predict 3 years worth of free cash flows, because I think it's really, really difficult to predict, say, 10 years into the future. I don't think I'm that clever to do that, but I think I can predict 3 years going into the future at a reasonable growth rate. So if we have a look at Alphabet, so what we've got here is, I think in 2021 their free cash flow is going to be 50 billion, 50 billion, then 60 billion, then 70 billion, and I'm pulling these figures from marketscreener.com. They have a very handy feature where analysts actually predict the free cash flow. So what you can do is you can have a look at the figures and see if they're reasonable to what you think they might be when you review the financial statements. So let's have a look. These figures are definitely updated since Google's earnings, so I'm not going to change them on the discount free cash flow, but let's say these figures, I'll pop into here. Let's be conservative and leave them figures there. So we predicted the free cash flows, and now we can go on to the final step, which is calculating the fair value of the company. So yeah, looking at Google, we have got the free cash flow at the top. We have got the discount factor, which is 10%. So we have discounted free cash flows, and the formula pulls together a terminal value, and it discounts the terminal value. And now we come to sorry, I froze there. So today's company value is all the free cash flows added together, divided by how many shares are outstanding. So the fair value of the company, we would say, is 1,311. And if we look at Google's stock price now, it is like an extra 1,000 added to that. So it's quite a lot higher than what we think the fair value is. But then the fair value of the equity, so what we've calculated, added what cash they've got, because Google are such a colossus that they've got so much cash around. I'd be looking to buy the stock at $1,500. Take it or leave it. So yeah, that's essentially it. You can add a margin of safety if you want as well, but I think with my discount rate of 10%, I think it pretty much covers quite a decent margin of safety. And then, going to the analysis checklist, what I would do is I would put what price, so I would do this for multiple companies, of course, and I would record it on this spreadsheet. Essentially what you can do is you can just have a massive list of them, or you can have this separate spreadsheet for all different companies. You can make copies and just have a folder of whatever you want to do. And what you can do is, once you've done your how to analyze stocks part, then what you can do is you can put how to value the stock in, and then you can work out how much it needs to fall before you buy it. Or alternatively, if it's at your price, you just go ahead and buy it. Pretty simple. So let's just leave it there in terms of the summary. I think if you want to learn more about how to value stocks, Jimmy, so Learn to Invest, has got lots of videos on his spreadsheet, and I think he'll do a much better job than I can. But I just wanted to show you how I interpret the spreadsheet and how I use it myself. I like to keep it very simple. I like to keep it pretty quick and easy. And I like to spend most of my time when I'm analysing stocks. I make sure the numbers are right, I make sure they look reasonable, and then I read more about the company. So if you'd like to learn more about discount free cash flow, please just send me a message or an email. More than happy to chat to you about it. Head over to Learn to Invest channel. Everything Money have also got a fantastic channel going through free cash flow, and there will be more videos explaining all of this going forward as well. So there we have it. That is how to value stocks using the discounted free cash flow spreadsheet. If you'd like a copy of the spreadsheet, head to the link in the description below and it'll take you to my website where you can download a copy for yourself and you can have a go. And also I'll link some videos below from Learn to Invest, Jimmy, because it's his spreadsheet and he's got loads of tutorials and little clip videos to go through it, which do a lot better job than I've just done. But I hope I've helped you out anyway, and I hope you've got you interested in the discounted free cash flow valuation. I think that's one of the main things I wanted to do. I wanted to get people who are interested in stocks using this spreadsheet and using it to, value stocks properly and the way it should be done. Well, in my opinion, anyway. But yeah, anyway, yeah. So thank you very much for watching the video. I've got a few bits to go through actually today. So I have just started my newsletter, The Harding Herald. I have been wanting to do a newsletter for a while now, and I finally found the right platform on Substack, and I've got over 100 subscribers getting my newsletter every single week. So if you are interested, please head to the link in the description below and subscribe to The Harding Herald. Plenty of investing content weekly on there, and you'll get my portfolio updates and everything you could ever want investing wise from Lewis Harding Invest. And also, if you would like to get some free shares, free Bitcoin, or any freebies and free trials, head over to my recommendations page over on my website. The link's in the description as well. I've done this page just to summarise all the different free affiliate links I've got. A lot cleaner and a lot easier for you as the user to go through. So I really hope you enjoyed today's video. Please like and leave a comment. It really does help me out. And if you're new around here, please subscribe to the channel and share the video. I'd really appreciate it. Anyway, thank you very much for watching. I'll see you next time.